Folks, in today's video, I want to talk about how to short GME, GameStop, and AMC. Now, first of all, yesterday of all days, I did a video on short interest and how to calculate short interest so that you can calculate and find stocks that are ripe for short opportunities. Typically, you want to find a stock that has a high short interest. Interestingly, one of the 5 stocks that I called out yesterday that was ripe for a short interest trade was AMC. Isn't that interesting? It had 68% short open interest yesterday, and I said it may be perfect opportunity to see exactly what we're seeing with GameStop, and here we are today. And as you can see, the stock is up 133%. Now, for most people, we know that movie theaters, let's be real here. We're not going to make money in movie theaters. Movie theaters are a dinosaur. If they do come back, and I doubt they will, it's going to take years. The odds are these AMC theaters are going to go belly up, just like GameStop. So in my opinion, you don't want to chase these stocks. You want to sell these stocks short. So I'm going to give you some options that'll allow you to take advantage of these opportunities to the short side. And please, please, please do not short the stock. If you short the stock and this short interest buying frenzy, this short squeeze or short covering continues, it can really cripple your position. I mean, look at GameStop. The stock is trading at $290 right now. GameStop selling used video games from brick and mortar stores trading at $290. That's an obvious short squeeze. So, but you don't want to imagine shorting the stock at 100 and now it's at 270. You want to buy a put option. So let me show you a good put option for GameStop that's trading at 290 right now. So premium is very, very expensive. So we have to not go too far out. So the near terms expire 3 days from now. This roller coaster may be with us for another few weeks. So we don't want to be too close. We want to buy an option that expires maybe on the 19th of next month, because the key here, we're not selling the option, we're buying the option. So we got 24 days left. And if you look at the puts, man, these puts are expensive. They are expensive, very, very expensive. But the odds are, this stock is going to go to a very, very, very low premium. For example, GameStop was in the teens before the rally started. So you're not going to be looking for an option that's in the money. You're going to be looking for an option that's out of the money. And right here, these options are 24 days till expiration. If you look at these strike prices, the cheap ones, they're really, really low, but there's a lot of open interest. So what I would personally do is I would go to something like the 100 strike price. Because if the option goes down 100 points, you'll make 20, 30 points out of that. If this stock goes from, let's say, $300 to $200, this option will become more expensive. So you don't want to go too much in the money because the options will become too expensive as we go higher up. So as you can see here, if you go to the 200 strike price, the option is going to be $100, and you don't want to pay that. You might as well just buy a stock. So what I would do is I would look for options near the 100 strike price, maybe the 150 strike price, like this option right here. Here's a $150 put option. It's currently about $69, $70, and the option has plenty of time till expiration. And if GameStop begins going down, and I believe it's going to go down before the 3 weeks are up, you will have the opportunity to make some money. Again, I wouldn't go too high up and I wouldn't go too low right now, but I would go probably to the about 150 strike price. You'll pay about $70, but the odds are if GameStop goes down, that option will go up instead. Look at the call options. Look at how much they've gone up in the last few days. Substantially. Look at that, 38%, 74%, 490%. So again, buying a put option right now may be a good alternative. And again, you don't want to go in the money or add the money. You don't want to buy a 300 strike price option. Go to something like 150. 150, it has decent volume 500 contracts. See if you can get it. If you can, give it about a week. If the asset doesn't start going down in a week, it would probably be a good time to start or think about liquidating it, or do a spread where you can sell, where you can buy the 150 and maybe offset it with a 100. So your expense is only, instead of $70, your expense is only about $40, but you get about $40 profit opportunity in it. So again, you could just do it by itself by buying the 150 put, or you can buy the 150 put and you could sell the 100 put to offset it. So your profit potential is still quite a bit high, and you're offsetting your premium by about 30 points. That's what I would do with GameStop, all right? And I think it's going to take less than 24 days for people to realize that this stock is just crazy overpriced. Now let's talk about AMC. AMC is up 150% right now. And again, I would do the exact same thing. Let's look at the options on it right now. And let's see what the option premiums are at. Here is a monthly option. Again, this option expires 24 days from now. And in this case, the puts are actually not that expensive yet. They may get there, but not yet. But I don't think we're going to see the same thing with AMC as we saw with GameStop. That's really one of a kind. So what I would be looking at right now is I would be looking probably at the $9 put or the $8 put. It has good volume right here. Or if you want to go a little higher, or a little lower, go to the $6 put. It has really good open interest and volume. Again, in this case, you're not spending $90 in options, so there's no need to do a spread. So I would, again, for both of these stocks, the AMC and GameStop, I would go with the expiration of February 19th. For GameStop, I would do probably a spread using the $150 put right here. Let's go to $150 put. And combining that, I would buy the 150 put and I would probably sell the 110, 115 put. And my expense would be the difference in those two strike prices, about 30, 40 points. But if that stock goes down, you can make some good money there. Alternatively, you can just buy the 100 put, and if the stock goes below 100, every dollar turns, and it increases from that point. But I would consider a spread. But for AMC, you still have the potential to make money on this stock with a regular put. And if this stock drops from the current price of $13 to about $6, $7, this option has the ability to about double in price. So again, the 6 would be a good idea in this case, because if it goes to about 6, the 6 option, and it won't take too long. It'll probably take about a week, maybe 10 days max, and this option gives you about 24 days. So again, $6 put, $2.52, has great open interest. $6 put expiring on February 19th. Hope that helps. Folks, 10-time trading champion Chuck Hughes just revealed a strategy that allowed him to bank, get this, $3.5 million in documented profits over the past 7 years. That's $500,000 a year. And for a limited time, we're giving you the chance to test drive the strategy for yourself. You see, Chuck agreed to sit down for an exclusive interview with me. And during our discussion, he showed me how this trophy trade system has allowed him to make consistent gains year after year, completely stress-free. Click on the button below to watch the interview today and find out how trophy trades can completely transform your returns and your life. But you got to do it now.